Hi, this is Ishfaq Khan, and in this video I'm going to tell you how to record inventory on net realizable value. Also, we are going to discuss how to create provision for inventories for slow moving items, damaged goods or obsolete goods, and how to deal provision for inventory as well with the help of example. So let's begin with the net realizable value. Suppose we have inventory of 10,000 but the net realizable value is 8,000. As per IAS2, we have to record the inventory on net realizable value or cost, whichever is lower. So in this case, our net realizable value is 8,000. Net realizable value means estimating selling price minus cost to sell. In simple terms, if your inventory cost is 10,000 but the amount that you can get due to any condition is 8,000, so now you have to reduce the amount. So how it will happen? What you will do, you will record inventory expense. You will record an expense of 2,000, not in the cost of goods sold but after gross profit. You will record here. You can name it as net NRV adjustment expense or any other similar name, or inventory written down expense, so with 2,000, and after that this will reduce the net profit. And similarly, as far as the balance sheet is concerned, you will immediately reduce the amount of inventory with 2,000. So inventory is 10,000 minus 2,000, so 8,000. In simple terms, you will record an expense of 2,000 and you will reduce the inventory with 2,000. So let's go and check for the provision for inventory. Now we have the same inventory of 10,000, but at that time we don't have net realizable value of 8,000, but we have a reliable estimate. The amount and only the amount and time is not certain, but we have make an estimation that 2,000 will be reduced based on some professional judgment. So there is a provision for inventory of 2,000. So what you will do, you will record an expense with 2,000, provision for inventory expense, debit, and then same amount you will reduce from the inventory as contra asset. So these will be the entries. You will debit provision for inventory expense account, credit provision for inventory liability or contra asset. So asset reduce in asset is credited or increase in liability is credited and expenses debit. So that's what happened over here. Now if the inventory in actual sense become obsolete and it has been reduced, so now at that time you will not record the expense but you will just reduce your asset with 2,000 and there will be no more. So your asset will become of 8,000 at that time. This entry will be done. Asset will be reduced, inventory asset will be reduced, and your liability will be reduced. So or reduction in liability is debit, or contra asset, same meaning, will be debited and inventory asset will be credited and it will become 8,000. Your inventory asset will become 8,000. Okay. Now what if there is reversal of that? There isn't any, this doesn't happen and you have to reverse that. Then what you will do, you will just debit the provision for liability. In this case it will become 0. It will become again 10,000 and reversal for inventory provision, and you will record this here on the same place where you recorded the expenses. Here you will record in positive. So here you will record as an other income at that time in the income. So this will become 2. There will be a reversal of that. So that's how it will work. I hope you like this video. Please click the subscribe button for me, share it with your friends and give me some motivating comments so I can release more videos of this kind. Thank you very much. Take care. Stay blessed.